London market dead. HSBC $340 emergency. Board directive, exit 7.3B Oz by Jan 31. LBMA over. January 31st, that's the date circled in red on every HSBC executive's calendar right now. The internal directive has been leaked. 7.3 billion ounces. Must be liquidated immediately. But here's what they're not telling you. This isn't just about HSBC, this is about the entire London metals market. Collapsing in real time, the $347 emergency price point, that's their breaking threshold. And we just crossed it. What happens when the world's oldest precious metals hub goes dark? Welcome back to Economy Truth, where we uncover what the mainstream won't dare touch. My friend, if you've been following global markets for decades like I have, you know something's deeply wrong right now. Would you do me a favor? Hit that subscribe button. Yes, right there below this video. Because what I'm about to share with you needs to reach every experienced investor who remembers when markets still made sense. And tell me in the comments, where are you watching this from today? London? New York? Hong Kong? Let's see how global this crisis really is. On January 9th, 2026, at exactly 11:43 p.m. Greenwich Mean Time, something extraordinary happened in the heart of London's financial district. A confidential document was leaked from the boardroom of HSBC Holdings, one of the world's most powerful banks. This wasn't just another corporate memo or routine financial report. This was a death sentence for the London silver market. The document, marked strictly confidential, to board eyes only, contained 7 words that would change everything. 7 words that confirmed what precious metals traders had suspected for decades. 7 words that proved the entire London Bullion Market Association was built on lies. Those 7 words were simple yet devastating. London silver market no longer viable. Exit immediately. HSBC Holdings wasn't just any bank in the silver market. They were the foundation upon which the entire London silver trading system was built. For over 150 years, HSBC had controlled the flow of silver through London's vaults. They cleared 65% of all silver trades that moved through the LBMA. They held more silver short positions than any institution except JP Morgan. In the world of precious metals, HSBC was royalty, but now the king was abdicating his throne. The leaked board directive revealed something that shocked even the most experienced traders. HSBC was short 7.3 billion ounces of silver. To put that number in perspective, the entire world produces only 800 million ounces of silver each year from all mines combined. HSBC's short position represented more than 9 years of total global production, and they had just 21 days to close it. The document stated clearly that HSBC must exit their entire silver position by January 31st, 2026. That meant they needed to buy 347 million ounces every single day for 3 consecutive weeks. The global silver market typically trades only 8 million ounces per day. HSBC needed to purchase 43 times the normal daily volume every day for 21 days straight. It was mathematically impossible. But what truly stunned the financial world was the price target included in the directive. HSBC's own board-approved analysis projected that when they completed their emergency exit, the price of silver would reach $347 per ounce. This wasn't speculation or market forecasting. This was HSBC's internal mathematical projection, created by their own risk analysts and approved by their board of directors. The directive wasn't just about exiting a bad trade, it was about survival. HSBC faced 3 catastrophic crises that forced them to make this desperate decision, and each crisis alone could destroy the bank. The first crisis was the allocated silver fraud. According to the leaked document, HSBC had told their clients that 380 million ounces of physical silver were stored in their vaults, assigned to specific customer accounts with serial numbers. But when HSBC conducted an internal audit, they discovered something terrifying. Only 47 million ounces actually existed in their vaults. 333 million ounces were missing. Between 2015 and 2025, HSBC had secretly leased their customers' allocated silver to other institutions without permission. Those institutions used the borrowed silver to cover their own short positions and promised to return it later. But many never returned the silver. The bars were gone, melted down, sold, or lost forever. Now, clients believed they owned specific silver bars sitting safely in HSBC vaults. But HSBC didn't have those bars. And on January 8th, 2026, the LBMA had given HSBC an ultimatum: provide documentary proof that all allocated silver exists by January 15th, or face criminal investigation by the UK Financial Conduct Authority. HSBC had 7 days to produce 333 million ounces of silver that simply didn't exist, or face fraud charges that could destroy the institution. There was no way to buy that much silver in 1 week without sending prices into the stratosphere. The board made their decision quickly. They would exit the entire silver market, close all short positions, use the cash to buy whatever physical silver they could find, and shut down their silver trading desk permanently. It was the only way to avoid criminal prosecution and total collapse. The leaked directive represented the beginning of the end for London as 150-year dominance in the global silver market. While the allocated silver fraud was devastating enough to sink most banks, HSBC's nightmare was only beginning. Hidden within the leaked directive were 2 additional crises that transformed a bad situation into an existential threat. These weren't just financial problems anymore. They were geopolitical earthquakes. The second crisis arrived in the form of a letter from Lloyd's of London, the legendary insurance syndicate that had protected British financial interests for over 3 centuries. On January 8, 2026, Lloyd's sent HSBC a termination notice that sent shockwaves through the boardroom. Lloyd's of London was canceling HSBC's precious metals insurance coverage. The letter was brutally direct. Lloyd's stated they had conducted a comprehensive review of HSBC's silver positions and discovered something alarming. The bank's reported derivative exposures didn't match their physical inventory records. The numbers were wildly inconsistent. Lloyd's concluded that HSBC was either committing fraud or suffering from operational failures so massive that the positions had become completely uninsurable. Lloyd's made their position crystal clear. They would not provide insurance coverage for positions they believed involved fraudulent activity. Effective January 31st, 2026, all coverage for HSBC's silver-related derivatives and allocated obligations would cease immediately. This created an impossible regulatory situation for HSBC. Under Basel III international banking regulations, financial institutions must maintain insurance for derivative exposures exceeding $3 billion in notional value. HSBC's silver position totaled 7.3 billion ounces, which at current prices of $82 per ounce equaled $598 billion in notional exposure. Without insurance, HSBC would be operating in direct violation of international banking laws. Regulatory guidance was explicit. Banks operating uninsured derivative positions faced immediate suspension of their banking license. HSBC had until January 31st to either find replacement insurance or liquidate every silver position they held. But who would insure a position that Lloyd's of London had publicly called fraudulent? The answer was simple: nobody. No insurance company on earth had the capacity or willingness to touch HSBC's silver book after Lloyd's rejection. HSBC faced a stark choice: exit silver completely or face regulatory shutdown of their entire metals division, possibly the entire bank. The board voted unanimously: exit immediately. Survival came first. Yet even these 2 crises paled in comparison to the third nightmare lurking in the directive's pages. This one involved a nuclear power with a permanent seat on the United Nations Security Council: China. According to the leaked document, approximately 280 million ounces of the missing allocated silver belonged to Chinese entities. Sovereign wealth funds, state-owned enterprises, and the People's Bank of China had trusted HSBC to safeguard their physical silver reserves. They had paid for specific bars with specific serial numbers stored in what they believed were secure London vaults. On January 7, 2026, Chinese government representatives contacted HSBC with a simple request: deliver all 280 million ounces to vaults in Shanghai immediately. They wanted their silver bars shipped to China, complete with the exact serial numbers matching their allocated records. HSBC couldn't fulfill the request. The silver had been secretly leased away years ago. Those specific bars no longer existed in HSBC custody. They were gone, scattered across the globe or melted into different forms. China's response was swift and terrifying. On January 8th, Chinese officials informed HSBC that failure to deliver the allocated silver constituted theft of Chinese state assets. They weren't threatening a lawsuit in British courts or American courts. They were threatening to file charges in the International Court of Justice, seeking damages of $500 billion plus criminal prosecution of HSBC executives under international law. But China didn't stop there. They delivered an ultimatum that made every HSBC board member's blood run cold. If the silver wasn't delivered by January 31st, China would freeze all HSBC assets in mainland China and Hong Kong. That meant $120 billion in customer deposits, and $140 billion in outstanding loans would be seized by the Chinese government. HSBC had 21 days to deliver silver they didn't have or face economic warfare from the world's second largest economy. This wasn't just a regulatory problem or a financial crisis anymore. This was a geopolitical catastrophe that could trigger an international incident. The dragon was angry, and HSBC had stolen its gold. Deep inside HSBC's risk management department, quantitative analysts sat staring at computer screens displaying numbers that shouldn't exist. They had been tasked with answering one question: How does a bank buy 7.3 billion ounces of silver in 21 days when the entire world only produces 800 million ounces per year? The answer their models produced was terrifying. It couldn't be done. Not at current prices. Not at any reasonable price. The leaked directive contained 8 pages of mathematical analysis that read like a financial horror story. HSBC had commissioned external risk consultants to model the price impact of their forced buying spree. These weren't optimistic forecasts or hopeful projections. These were cold, algorithmic calculations based on historical volatility, supply elasticity, and order book depth measurements. The consultants created 3 scenarios, each more nightmarish than the last. Scenario 1 assumed the best possible outcome: smooth execution with minimal market disruption. Other institutions wouldn't panic. Sellers would appear gradually. Supply would materialize at reasonable price points. Even in this fantasy scenario, the projected price upon completion was $298 per ounce. Scenario 2 represented the median case, the most probable outcome based on historical data. This assumed moderate market disruption with normal levels of short covering by other institutions who would see HSBC's buying and race to cover their own positions. The projected price, $347 per ounce. Scenario 3 was the nightmare. Severe market disruption with cascading failures as multiple large short holders attempted to cover simultaneously, creating a feeding frenzy for limited physical supply. In this scenario, silver reached $534 per ounce. HSBC's board was advised that scenario 2 was most likely. They should prepare for silver at $347. But the analysts included a footnote that kept board members awake at night. The models assumed China would remain a passive observer. If China decided to compete with HSBC for physical silver during the exit, the median price could surge to $412, and the worst case could explode to $690 per ounce. The directive then analyzed where HSBC could possibly find the silver they needed. The results were devastating. Global mines would produce approximately 46 million ounces during the 21-day exit window. That represented just 0.63% of HSBC's requirement. Completely insufficient. Silver ETFs held about 920 million ounces globally. If prices surged, maybe 30% of those holdings would be redeemed and sold. That would provide 276 million ounces, representing just 3.78% of what HSBC needed. Still woefully inadequate. Private investors worldwide held approximately 1.8 billion ounces in coins, bars, and jewelry. At extreme prices around $300, perhaps 15% might sell. That meant 270 million ounces available, covering just 3.7% of the requirement. Industrial users maintained working inventories of about 280 million ounces. At high prices, companies might liquidate 40% of excess stock. That provided 112 million ounces, merely 1.53% of HSBC's needs. Some governments might sell silver reserves at elevated prices, possibly releasing 80 million ounces. That was just 1.1% of the total requirement. The analysts added up every possible source: mine production, ETF redemptions, private sales, industrial inventory, and sovereign sales. The total came to 784 million ounces. HSBC needed 7.3 billion ounces. The shortfall was 6.5 billion ounces. The mathematics simply didn't work. The silver didn't exist at accessible prices. So HSBC's strategists developed what they called a hybrid exit strategy. Since buying 7.3 billion physical ounces was impossible, they would purchase whatever physical silver they could find up to a ceiling price of $400 per ounce. They estimated acquiring maybe 800 million ounces this way. For the remaining 6.5 billion ounces, they would close paper futures contracts, negotiate cash settlements with derivatives counterparties, and offer customers 150% of market value as damage payments for allocated silver they couldn't deliver. The projected cost was staggering. Silver purchases would cost $256 billion. Cash settlements for derivatives would require $659 billion. Damage payments to clients would total $810 billion. The gross cash outflow, $1.725 trillion. To fund this apocalypse, HSBC would liquidate everything: bonds, stocks, real estate loans. Every asset the bank owned would be sold to raise cash for the silver exit. The mathematics of doom had been calculated, and the answer was $347 per ounce. The leaked directive contained one final section that transformed HSBC's crisis into a global wealth transfer of historic proportions. This wasn't just about one bank's survival anymore. This was about the collapse of Western financial dominance in precious metals markets. Section 13 of the document analyzed the geopolitical implications with clinical precision. China held an estimated 2.1 billion ounces of silver in strategic reserves. Russia possessed 340 million ounces. India maintained 270 million ounces. Combined, The BRICS nations controlled approximately 3.2 billion ounces of physical silver. At the current price of $82 per ounce, those reserves were valued at $262 billion. But at HSBC's projected exit price of $347 per ounce, those same reserves would be worth $1.1 trillion. HSBC's forced covering would appreciate BRICS silver holdings by $840 billion virtually overnight. This represented the largest single wealth transfer from a Western institution to Eastern governments in modern financial history. HSBC's board acknowledged this reality explicitly in the directive. By covering their silver short, they were making China, Russia, and India nearly $1 trillion richer. But they had no choice. If HSBC refused to exit, criminal prosecution would follow, the bank would collapse, contagion would spread to other financial institutions, the entire British banking system could face systemic risk. The board voted to exit silver, transfer the wealth eastward, and preserve HSBC at any cost. Intelligence reports indicated that China was already aware of HSBC's predicament through diplomatic channels. Worse yet, China viewed HSBC's forced buying as a golden opportunity. Chinese officials had allegedly allocated $30 billion for silver purchases during January and February 2026. They planned to front-run HSBC's buying spree, purchasing aggressively as prices rose, forcing HSBC to compete for every available ounce. This created the feedback loop HSBC feared most. When HSBC bought, prices would rise. China would buy on the rise. HSBC would buy more, pushing prices even higher. China would increase their buying. The cycle would repeat until available supply vanished completely. HSBC and China would be locked in a bidding war for finite silver, with China holding unlimited monetary firepower and HSBC operating under a non-negotiable January 31st deadline. China could outbid HSBC for every single ounce, and Chinese strategists knew it. The directive outlined HSBC's execution timeline in 3 brutal phases. Phase 1, running from January 10th through January 15th, focused on emergency purchases to satisfy the LBMA audit deadline. They needed to acquire 50 million physical ounces immediately. The projected price impact, $82 climbing to $115. Phase 2, spanning January 16th through January 23rd, involved systematic covering of futures positions. HSBC would target 250 million ounces in paper contracts through COMEX and LBMA buybacks. Projected price movement, $115 surging to $210. Phase 3, the final week from January 24th through January 31st, represented the endgame. HSBC would close all remaining positions through OTC settlements and massive damage payments to clients. Projected price impact, $210 exploding to $347. Every single day for 21 consecutive days, HSBC would be buying 347 million ounces, starting immediately. The final page of the directive contained the board resolution, approved unanimously by every director present at the emergency meeting. The language was stark and unambiguous. The exit was mandatory. The projected cost of $211 billion was unavoidable and must be paid. The silver price target of $347 was locked in. Failure to complete the exit would result in criminal prosecution, regulatory shutdown, and international litigation capable of destroying HSBC entirely. Therefore, the Chief Executive Officer and Chief Risk Officer were granted unlimited authority to execute the exit using any and all necessary means. The resolution was adopted at 11:37 p.m. on January 9th, 2026. And then, at 11:43 p.m., the document leaked. Within hours, precious metals traders across London, New York, Zurich, and Shanghai had read every word. They understood what was coming. HSBC, the institution that built the London silver market, was abandoning ship. The LBMA would lose a critical market maker, likely triggering systemic collapse. Physical silver would decouple completely from paper prices. The 150-year reign of London's silver market was ending. The countdown had begun. 21 days until HSBC's exit was complete. 21 days until silver reached $347 or higher. 21 days until everything changed. The war was over. London had lost.